Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. We're going to talk about recovery today. It seems like an easy topic, but it's really not, and quite often it's applied in the wrong context. So let's start out with an old proverb we've always heard our entire life. You can't cry over spilt milk. Or don't cry over spilt milk. It's an interesting little proverb that has a very important part in trading. And it is a nuance that really cuts to the heart of something that often gets overlooked and not practiced enough. As you know from previous videos, I took 8 stop losses, which meant I lost about $50 from my main account. This is, of course, a live look at the market right now at this very moment. And we can see how the last several weeks have gone. But the big note, the big situation is my recovery. The recovery of 8 stop losses. I was at 49% margin used, and my bots did their job. They mitigated risk, they took the stop losses, they kept me from a margin call. But it cost me money in the process. I recovered from those losses. Now, the distinction I made there is important because trading is about psychology. I did not recover the losses themselves. And that's one of the biggest mistakes that I hear in trading constantly, is people saying they recovered their losses. No, they did not recover their losses. They recovered from their losses. There is a distinction that is important. It's just like you can't recover spilt milk. You can recover from spilling your milk, but you can't recover the actual spilled milk. In the context of trading, I can recover from my losses, but I can never reclaim or recover the money I actually lost. I can earn more money to recover from the total of my losses. This psychological nuance is critical because if you don't practice it, it becomes all too easy to get into a situation called revenge trading. If you accept up front that you can never recover your losses, then you've already taken a major step to preventing yourself from revenge trading. Revenge trading will wipe out your account. It will blind you to the fact that the market is what it is, and sometimes you just need to step away and leave it alone. It is a situation that destroys traders. And it does so in a way that just is completely blinding. Many people don't realize they're even revenge trading until it's too late. And it's all because of the assertion of the recovery process. And that is recovering money versus recovering from a loss. Even though they sound the same, contextually they're not. They're very difficult to separate sometimes, but they're very distinctive in their intent. You will always recover from your losses if you have a good, stable strategy. But you will never recover the actual losses themselves, no matter what. This is absolutely critical in understanding because having that psychological edge keeps you out of the revenge trading situation. Now, looking at last week's market and the week before, we can see where the market took a heavy downturn after the CPI insanity of a couple of weeks ago. The market went through a brutal correction. And for me, it was extremely profitable, but only because I had a worst case scenario plan. Without that worst case scenario plan, I would have lost a lot more money. But because of what I had in place, I profited a lot. Enough to recover from 8 stop losses. As we can see, after the stop losses, I was at $1,330. I'm now at $1,388. When I first ended up feeling the stop losses, my balance was $1,381. So I have recovered from those losses. And I am moving forward with my projections of profitability. It is critical that you think about the psychology that you are using in your trading. Subtle little changes can make a big difference in how you view the market and how you perceive an individual trade in such a way that you protect yourself from getting caught up in the emotion of what happens. For example, as we look at these two bullish candles, people that were shorting the market, like me, saw themselves going into a very high-risk situation. I literally went from a 5% margin level to 49% of my margin. If it had not been for my worst case scenario plan, I would have been liquidated. Bottom line, no questions about it, I would have lost half my account through a liquidation. But because of that worst case scenario plan, I took 8 deliberate stop losses that kept my account from being liquidated. I lost $50. That hurt because this account still has not recovered from that loss. And we'll show that in a few minutes with some pretty little pictures. But for now, we can see that my total real money budget is indeed above the actual amount I lost. So I have recovered from it, and I have gained back that money through trading. I have not recovered the initial loss. That will never happen. But I have earned more money in the process to recover from that initial loss. So now let's look at the Australian dollar, US dollar. This is actually what drove my recovery. As we can see, the market just took a tumble. For somebody in a bearish trade, as I typically do, this was a lifesaver. It really brought home the profits. It cleaned off close to 30% of my margin. And I took in all of that as pure profit. It is why I was able to recover from my 8 stop losses. I got lucky in that this happened as fast as it did. But the recovery process itself was not luck. A worst case scenario plan guarantees you within reason a recovery. You're just never guaranteed how long that recovery will take. In my case, it took about 5 days to completely recover from what I had lost. So let's get into the charts and actually see how well this looks like. First, we will look at the equity chart and see just exactly where each pair did what it did in relation to my total balance. Okay, we are looking at the equity of my Euro USD account. The Euro USD pair where I took the 8 stop losses. As you can see, those 8 stop losses are still here, and this pair has not recovered. It is still in a loss of what I actually lost, and it's going to take time for that to recover from these losses. As we can see from the chart, looking back, it looks like it will take at least 30 days, potentially 60, for this account to recover from those 8 stop losses. But if we go to the second pair that I trade, Australian dollar, US dollar, we can see exactly where the money came from that contributed to my account recovery process. And this is really the distinction. When you're dealing with multiple pairs, if one pair takes a loss, another pair can contribute to the recovery process, even though it's not ever going to recover the initial loss. All of this profit that I earned here worked towards bringing my account back to the point I had it before the stop losses took place. That is a pivotal understanding of the psychology behind trading. And this is a psychological game in a lot of ways. Now let's look at the trades themselves. We can see the trades that have taken place after the losses have not been that significant. But we can see the stop losses, all 8 of them right here. Now let's look at the Australian dollar, US dollar trades. And we can see the massive wall of sell-offs that took place, the point by which I made profit. And this is a critical distinction of how that profit came about. We can see clearly how things played together. If we zoom in and we actually look at these selling points, we can see the days that the sales took place on and how those sales contributed to the recovery process and my account recovering from the losses. We can see the volatility in play as price dropped rapidly in certain places. All of these factors play together in a meaningful way, and by trading and looking at your recovery process and thinking about the recovery steps needed, you have the mechanisms necessary with proper planning and a worst-case scenario approach to recover from your losses. But you will never, ever recover your losses. Once that money is gone, it is gone. So as you look at your trading, as you think about the market, and you take in the different parts of your trading strategy, You need to think about the recovery process as a critical component of your balance preservation techniques, because the recovery process is just as critical as the rest of your risk mitigation approach, because technically the recovery process is part of the risk mitigation, because sooner or later you are going to take a loss, and that loss is going to have an impact on your account. Whether it's short term or long term, that loss is going to be effective in being felt moving forward in your trading. It's just not going to magically go away. Even if you recover from the loss and earn more money, the impact of the loss is still a permanent record on your account. So, as you think about your steps, always keep that in mind. If you like this video, please give it a thumbs up. Please share it and help me grow the channel. If you're not subscribed, please subscribe. If you have any questions, please leave them in the comments below. How have you done so far? Have you recovered from your losses? Have you ever been caught in a revenge trading situation? I know personally when I was first learning how to trade, yes, I was. And it had a major impact on my recovery in the long run. It slowed it down drastically because I didn't understand that I simply couldn't recover what I'd already lost. It took me time to understand that rationale. But just like the proverb of not crying over spilled milk, once I realized the meaning behind that in the context of trading, it gave me a different point of view to think about and helped me become a better trader. So share your thoughts. I'd like to hear your stories, hear your life's experiences on how you've recovered from various losses along the way. I hope you've enjoyed this video, and thank you for watching. Until next time.